Most people are misreading XRP right now. While many investors are focused on short-term price action, several market cycle indicators suggest XRP may be entering one of the most important phases historically associated with long-term positioning. The reason this matters is simple. The biggest market moves often begin when public interest is fading, not when excitement is peaking. In this video, we're going to break down where XRP sits in the current market cycle, what volume and investor behavior are revealing, how whales have historically positioned themselves during similar phases, and why understanding these patterns could completely change how you view the next few years of the crypto market. Let's start with the data first. Over multiple crypto cycles, one pattern has appeared again and again. Retail investors tend to become most active near cycle highs. Whales tend to become most active when interest is low. The difference has helped create billions of dollars in gains for large market participants, while many smaller investors repeatedly enter at the wrong time. And XRP has followed similar cycle behavior throughout its history. When we look back at 2017, 2021, and the most recent 2024 to 2025 cycle, we can see the same four-stage structure appearing repeatedly: accumulation, markup, distribution, and markdown. See, the interesting part isn't that these cycles exist. It's that most investors only recognize them after they've already happened. Right now, several indicators, including volume trends, market, participation, and historical cycle structure, are raising an important question. Is XRP entering another accumulation phase before the market realizes it? Because if history is even partially rhyming, what looks like quiet on the surface may be far more significant underneath. If you want the satellite perspective on XRP and the crypto market and want to cut through the daily chaos and noise, subscribe, like, share these videos. I break it down simply so you can see what actually matters in this market. I want to talk about the four stages of every crypto market cycle, ladies and gentlemen. See, to understand XRP's future potential, we need first to understand the four phases that have repeatedly appeared across crypto history. Think of them as the four seasons of the market. Each has different characteristics, different emotions, and different participants. Let's start with stage one, baby. Accumulation. Accumulation is usually the most boring phase. Prices have already fallen, excitement has disappeared, trading activity slows dramatically, media coverage fades. Many investors simply give up. This phase often lasts between 12 and 24 months. That's exactly why whales love it. When public interest is low, large investors can quietly build positions without attracting attention. Volume remains subdued, price action appears directionless, nothing seems exciting. But beneath the surface, positions are being built. See, historically, analysts often watch major support levels and long-term moving averages during these periods. Market participants view moves below the 200-week simple moving average as areas where long-term value may begin emerging. This is not guarantees, but potential opportunity zones. The key characteristic: patience. Accumulation rewards patience more than excitement. 2, markup. Then comes the second phase. Markup, baby. This is where things become increasingly interesting. Prices begin climbing, momentum returns, volume increases, optimism spreads. What looked like a dead market suddenly comes back to life. Yay! Capital starts flowing back into the sector. New narratives emerge. Institutional interest often increases here. Major macroeconomic events can accelerate these moves. Political developments, regulatory shifts, economic policy changes, global liquidity conditions. Everything begins working together. So for XRP supporters, often point to periods where major external events coincided with significant price appreciation. Momentum builds, confidence returns, and the market enters its most exciting stage. But here's where it gets interesting. The phase that creates the largest gains also plants the seeds of the next decline. I want you to think about the California gold rush. History has always provides fascinating lessons and examples. In 1858, news spread that gold had been discovered in California. Within months, thousands of people rushed west. Many arrived believing wealth was guaranteed. The excitement became self-reinforcing. Most people arrived because more people were arriving. Sound familiar? As the rush intensified, opportunities to come and find land became harder to find. Competition exploded. Expectations became unrealistic. Eventually, many late arrivals discovered that the easiest profits had already been made. See, the greatest fortunes often belonged not to those chasing the excitement at the end, but to those who position themselves early. Crypto markets frequently display similar psychology. When everyone's talking about easy gains, markets may already be much further along in their cycle than people realize. And that's where the third phase begins, ladies and gentlemen. Distribution, the phase that fools most people, unfortunately. Distribution is one of the most misunderstood phases in investing. See, on the surface, everything appears healthy. Prices remain elevated. News remains positive. Influencers remain bullish. The public becomes increasingly confident. Yet beneath the surface, something important changes. Large holders begin selling, gradually, strategically, quietly. This is often where retail participation reaches its highest levels. Fear of missing out becomes overwhelming. Investors who ignored the market during accumulation suddenly became eager buyers. Volume surges. Search interest explodes. Social media activity reaches extreme levels. And many newcomers enter positions near cycle highs, not because they are irrational, but because human psychology naturally seeks confirmation. People feel safest buying when everyone else is buying. Unfortunately, markets often work in reverse. The moments that feel safest can sometimes carry the greatest risk, and the moments that feel uncomfortable can sometimes contain the greatest opportunity. That doesn't mean price immediately collapses. Distribution can last for months. Markets may move sideways. They may form double tops. They may continue producing bullish headlines. But eventually, supply begins overwhelming demand, and the fourth phase arrives. Markdown begins. See, markdown is the phase nobody wants to talk about during a bull market. Price declines, volume contracts, optimism disappears, narratives weaken, investors begin questioning decisions they felt confident about only months earlier. And eventually, the cycle completes itself. The same market that moved through accumulation, then markup, then distribution, returns once again to accumulation. And a new cycle begins. A new opportunity emerges. And the process repeats. But understanding the cycle is only half the story, ladies and gentlemen. Because the real question is this: how do whales consistently profit from these phases while retail investors repeatedly struggle? See, the answer becomes clearer when we examine volume, market psychology, and one surprisingly powerful indicator that has predicted investor behavior for years: Google Trends, the secret language of volume. If price tells you what the market is doing, volume often tells you who's doing it. This is one of the oldest principles in financial markets, and it remains incredibly relevant in crypto today. Most retail investors focus almost entirely on price. They watch green candles. They watch red candles. They celebrate rallies. They panic during corrections. But large investors frequently focus on something deeper: participation. Because volume measures participation. It reveals how much conviction exists behind a move. And throughout crypto history, volume has displayed a remarkable consistent relationship within market cycles. This is so important. This is in every market, ladies and gentlemen, not just crypto. See, during accumulation phases, volume tends to be quiet. Nothing exciting appears to be happening. Media coverage shrinks. Public attention fades. The market feels abandoned. This is often when patient capital begins positioning. Then markup arrives. Volume expands rapidly. Momentum builds. More participants enter. Prices climb. Confidence grows. Suddenly, everyone's paying attention again. Then comes the distribution phase. And this is where volume becomes particularly important, because volume often reaches extreme levels precisely when public enthusiasm reaches its peak. Retail investors finally enter. Social media engagement explodes. Influencers gain millions of views. Search activity accelerates. The crowd arrives. And that surge in demand creates liquidity. Liquidity that large holders can potentially sell into. Now, this is what most people miss. Whales don't need retail capital or retail investors to be wrong. They simply need them to arrive late. That's often enough. Finally, markdown begins. Volume contracts. Participation declines. Excitement fades. The market gradually returns to the quiet conditions that started the cycle. The pattern repeats again and again across multiple asset classes, across multiple decades, across multiple technologies. But volume isn't the only signal investors watch. There's another indicator that may reveal market psychology with surprising accuracy, one that almost everyone uses every day: Google. Google trends the crowd's emotional thermometer, ladies and gentlemen. See, imagine having a tool that measures public curiosity in real time. It's amazing, right? A tool that shows exactly when people become obsessed with a topic. That's essentially what Google Trends provides. While it isn't a perfect market indicator, it offers a fascinating window into investor psychology. Historically, crypto-related searches tend to follow a similar pattern. Interest remains low during bear markets, search volume flattens, public curiosity fades, many people stop paying attention entirely, then prices begin recovery. At first, almost nobody notices, then recovery feels small, temporary, unimportant. But as gains accelerate, public attention returns. Search volumes climb, news coverage expands, social media discussions increase, and eventually interest reaches a frenzy. During major bull runs, Google Trends scores have repeatedly surged towards maximum levels. People search for Bitcoin, Ethereum, XRP, altcoins, NFTs, crypto wallets, crypto exchanges, everything. The public suddenly wants answers. And that's often where cycles reaches its most dangerous stage, ladies and gentlemen. It does. Not because growth immediately ends, but because expectations become disconnected from reality. Everyone expects price to continue rising forever. Markets rarely work that way. The interesting observation from recent years is that baseline awareness of crypto appears significantly higher than it was in early cycles. More people understand digital assets. More institutions participate. More regulators enter and engage with the industry. More governments discuss blockchain technology. As adoption increases, future cycles may not look identical to previous ones. That doesn't mean cycles disappear. It simply means they evolve. And that's a crucial distinction. Prices reacting, systems evolving. Many investors focus on the first part. The biggest opportunities may emerge from understanding the second. I want to talk about the Roman road network. See, to understand what's happening beneath the surface, consider an analogy from ancient history. Imagine the expansion of the Roman road network. At first, roads were built slowly. Many people failed to appreciate their significance. The infrastructure existed before the economic explosion. Merchants, armies, communication systems, and trade routes all expanded because the foundation had already been established. Crypto adoption can be viewed through a similar lens. Prices attract headlines, but infrastructure often develops quietly. Regulatory frameworks, custody solutions, institutional participation, payment systems, settlement technologies. These developments may not create immediate price spikes, yet they can fundamentally alter how markets operate over the long term. Just as Roman roads transformed commerce long after construction began, modern digital asset infrastructure could influence markets in ways that aren't immediately visible through price action alone. And that brings us directly to XRP's current position. Because according to many market cycle analysts, XRP, the anointed one, may be entering one of the most misunderstood phases of the entire cycle. So where exactly does XRP fit within this framework, you're asking? This is where opinions begin to differ. No one with certainty knows what will happen next. Markets remain unpredictable. I always say death by 1,000 headlines and tweets. But many cycle analysts point to several signals suggesting XRP may currently transitioning through an early distribution to accumulation overlap phase, following the explosive activity seen during the 2024-2025 period. So let's examine the evidence. First, trading volume. During periods of peak excitement, XRP experienced enormous participation levels. Daily trading activity surged dramatically as investors rushed to the market. But as the market cooled, volumes began falling sharply. This isn't unusual. In fact, this is exactly what previous cycles have shown. After major rallies, participation often declines. Speculators leave. Short-term traders move elsewhere. The market enters a quiet phase. And that's precisely what accumulation environments typically look like. Sound very interesting when I say pay attention to what's quiet, always, over and over. Well, let's get to second, price behavior. Rather than continuing a straight upward trend, XRP has spent significant time moving sideways and consolidating. Many analysts view this type of action as a natural process following periods of extreme volatility. Markets need time to absorb gains, time to establish support, time to determine fair value. That process can feel frustrating, especially for investors expecting immediate continuation. But historically, consolidation has often been part of a larger market cycle, not the end of it. Now, this is where it gets interesting. The majority of investors struggle most during periods of sideways movement, not because they're losing money, but because nothing appears to be happening. Human beings crave action, attention. Markets frequently reward patience. So here's why accumulation feels so uncomfortable, ladies and gentlemen. Think back to every major market opportunity in history, okay? Very few felt obvious at the time. The best opportunities rarely arrive with fireworks. It's like watching paint dry on the wall. I say this over and over again. They usually arrive with uncertainty, doubt, boredom, confusion, blah, 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 blah. They do. It's boring. Accumulation phases are psychologically difficult because they provide very little immediate reward. There's no dopamine with this one. Prices move very slow. News becomes repetitive. Social engagement falls. Excitement disappears. Yet historically, these have been often periods where long-term positions were built. That doesn't guarantee future performance, ladies and gentlemen. None of this is financial advice. It's my own opinion, and it retains any capacity. But it helps explain why experienced investors frequently pay close attention when public interest begins fading. Why I say pay attention to what's quiet. Because the market's emotional cycle often moves opposite to the market's opportunity cycle. And history provides another remarkable example of this phenomenon, one that reshaped the global financial system itself. I want to talk about the 1932 market bottom. See, in 1932, during the depths of the Great Depression, confidence in the financial markets had nearly vanished. Businesses were failing, unemployment was soaring, investors had endured years of losses, fear dominated public sentiment. For many people, the idea of buying assets seemed irrational, yet historians and market scholars often point to that period as one of the greatest long-term accumulation opportunities in modern financial history. Why? Because sentiment had become overwhelmingly negative. The public focused on immediate pain, long-term investors focused on future recovery. Again, the lesson isn't that every depressed market automatically rebounds. The lesson is psychological. Major opportunities often emerge when confidence is lowest, and major risks often emerge when confidence is highest. Markets have demonstrated this pattern repeatedly throughout history. Whether we're discussing stocks, commodities, real estate, or crypto, human beings remain surprisingly consistent. And if that consistency continues, the next question becomes incredibly important. Where could XRP ultimately find support before the next major cycle begins? Let's talk about the support zones investors are watching. See, every market cycle eventually reaches a point where investors begin asking the same question. Where is the floor? Where does selling pressure finally begin to exhaust itself? So for XRP, many cycle analysts have identified a potential support region between approximately 85 cents and $1. Not financial advice, just my own opinion, and retains any capacity. Now, it's important to understand what support actually means. Support is not a guarantee, not a prediction, and certainly not a promise that prices cannot move lower. Instead, support represents an area where historical buying interest has previously emerged, a zone where market participants may perceive value. Why are analysts watching this range? Because previous XRP cycles have shown similar behavior. After major rallies, XRP has historically experienced substantial corrections before eventually stabilizing and beginning a new accumulation phase. Looking back at earlier market cycles, investors can see a recurring pattern. First comes excitement, then euphoria, then disappointment, then stabilization, and finally recovery. The exact number changes, the timing changes, but the structure often remains remarkably similar. This is why experienced investors spend less time trying to predict tomorrow's price and more time trying to identify broader market conditions. Short-term noise, long-term structure. The distinction may be one of the most valuable lessons in investing, ladies and gentlemen. Because if XRP, the anointed one, ultimately establishes support within this region, many market participants believe the next phase of the cycle could begin taking shape. And that's where participation for the next bull market enters the conversation. So let's talk about the next XRP bull thesis, ladies and gentlemen. One of the most widely discussed topics and ideas among XRP supporters is the possibility of a significant appreciation cycle between late 2026 and early 2027. Some analysts suggest that if historical cycle structures continue, XRP could potentially experience gains exceeding 5 times its accumulation zone prices. Again, this is not a forecast. It's not financial advice, ladies and gentlemen. It's just my own opinion. And there are countless variables that could influence outcomes. But understanding the logic behind the thesis is important. The argument is relatively simple. Previous XRP cycles have demonstrated a tendency to move through long periods of accumulation, followed by powerful markup phases. When liquidity returns to the market, when investors' confidence improves, when institutional participation increases, and when macro conditions become favorable, digital assets have historically experienced explosive upside moves. See, supporters of the bullish thesis believe XRP could benefit from a combination of factors: growing regulatory clarity, increasing institutional engagement, expansion of blockchain payment systems, always understand that, broader crypto adoption, and the return of risk appetite across global markets. Whether those conditions materialize remains uncertain, but investors are watching closely because major market moves rarely happen in isolation. They emerge when multiple forces align simultaneously. Right now, several forces are beginning to attract attention. But we still have the regulatory question, ladies and gentlemen. See, if there's one factor capable of accelerating delaying market cycles, it's regulation. Throughout crypto's history, regulatory uncertainty has been one of the industry's greatest challenges. Investors dislike uncertainty. Institutions dislike uncertainty even more. Large financial organizations generally prefer operating within clearly defined legal frameworks. Without clarity, participation often remains limited. With clarity, entirely new pools of capital may become available. This is why developments involving lawmakers, regulators, and digital asset legislation receive so much attention. Many market participants are closely monitoring initiatives designed to establish clearer rules for digital assets. See, supporters argue that regulatory clarity could reduce uncertainty and encourage broad institutional adoption. Critics argue that regulation could also introduce new restrictions. The reality is likely more nuanced. Regulation is rarely purely positive, purely negative. Instead, it creates structure, and structure often allows markets to mature. Now, this is what most people miss. The biggest market transformations often happen long before price reflects them. The headlines focus on daily volatility. The structural shifts happen quietly in the background. But years later, investors look back and realize the foundation was being built the entire time. Prices reacting, systems evolving. And that evolution may ultimately matter more than any single price movement, ladies and gentlemen. I want to talk about the Transcontinental Railroad. So to understand this concept, let's consider another historical analogy. Imagine the construction of the Transcontinental Railroad in the United States. During construction, many people focused on immediate challenges, costs, delays, political disputes, engineering obstacles. What they couldn't fully see was the long-term transformation being created. The railroad simply didn't connect cities, ladies and gentlemen. It changed transportation. It changed economic activity across an entire continent. Digital asset infrastructure may be experiencing a similar process. Most headlines focus on price fluctuations, but beneath the surface, networks are expanding, institutions are experimenting, governments are evaluating frameworks, financial systems are adapting. The short-term story is volatility. The long-term story may be infrastructure. And history repeatedly shows that infrastructure often matters more than speculation, ladies and gentlemen. Geopolitics, liquidity, and the global market. See, of course, the crypto markets do not exist in a vacuum. They're increasingly connected to global events, ladies and gentlemen. Interest rates, monetary policy, geopolitical tension, economic growth. All these factors influence investor behavior. Whenever uncertainty rises, risk assets often experience pressure. When liquidity expands, risk assets frequently benefit. This is why some analysts point to ongoing geopolitical developments as potential variables affecting crypto market timing. Conflicts, trade disputes, and international uncertainty can temporarily suppress investor confidence. At the same time, improving conditions can rapidly restore optimism. So the key takeaway is simple. No market cycle unfolds in isolation. Crypto responds to broader financial conditions just as other asset classes do. The difference is that crypto often reacts faster and more dramatically, which is why understanding both macroeconomics and market psychology has become increasingly important. Investors who focus exclusively on price may miss the bigger picture. Investors who understand structure may gain additional perspective. So here's the big picture of XRP, ladies and gentlemen. Let's zoom out. Over the past decade, XRP has experienced multiple cycles, periods of explosive growth, periods of painful corrections, periods of prolonged consolidation, and periods of renewed optimism. Each cycle has looked different on the surface, yet the underlying structure has often remained surprisingly consistent. Accumulation, markup, distribution, markdown, and the process begins again. According to the market cycle framework we've discussed today, XRP may currently be moving through the quieter stages that historically preceded large market moves. That does not guarantee a rally, ladies and gentlemen. It does not guarantee new all-time highs, but it does provide a framework for understanding what many analysts are watching: support levels, volume trends, Google search activity, institutional developments, regulatory progress, and broader macroeconomic conditions. And all those pieces contribute to the larger puzzle. And over the coming years, investors will be watching closely to see how that puzzle develops. So what have we learned today, ladies and gentlemen? First, crypto markets have historically moved through four primary stages: accumulation, markup, distribution, and markdown. Second, whales or large investors often focus on cycles, positioning rather than emotional reactions. They seek opportunity when attention's low and frequently reduce exposure when attention becomes excessive. Third, indicators such as volume and Google Trends can offer valuable insights into market sentiment, not because they predict the future, but because they reveal how investors are behaving in the past. Fourth, many analysts believe XRP may currently be approaching or entering an accumulation-oriented environment, following the volatility of previous years. And finally, future outcomes could be influenced by a combination of regulation, institutional participation, macroeconomic conditions, and geopolitical developments. The future remains uncertain, ladies and gentlemen, but the structure is visible. And understanding that structure may help investors make more informed decisions. Because in every market cycle, the biggest opportunities often appear long before the crowd recognizes them. If you enjoyed this breakdown, make sure to subscribe and turn on notifications for future XRP, crypto, and macroeconomic analysis. Let me know in the comments which stage of the market cycle do you believe XRP is currently in? Accumulation, markup, distribution, or markdown? I'd love to hear your perspective. And remember, the loudest headlines often focus on price. The most important developments often happen beneath the surface, ladies and gentlemen. Short-term noise, long-term structure. Prices react and systems evolving. Pay attention to what's quiet, I always say. Thank you for watching, ladies and gentlemen. I'll see you in the next one. Hope everyone's having a great day. I want to welcome all the new members of the Patreon, the Crypto Public Desk Monthly, all the new members of the membership channel. If you're looking to learn how to trade, to invest, come and join the Crypto Public Desk Monthly, ladies and gentlemen. Doesn't matter where you are in your journey, if you're a seasoned veteran or if you're just starting out and you want to learn and you want your hand held. Join over 600 active traders and investors who are wanting the deeper macro research and they want to learn how to take advantage of equities, futures, crypto, the whole gauntlet. They want to learn how to trade, to invest, positioning, everything. The big thing that I am paying attention to, right, is this. When does the erosion of sentiment that has entered here, like high tide, about higher rates, go out? Into what's quiet here, ladies and gentlemen, is this is most important, okay? That's most important. And why I say that's most important is that is when we will see things change. And when those things begin to change, that is when situations in the markets begin to change. That is when the phases that we just spoke about, that I just outlaid, begin. Traders and in funds, everyone's got to make their weekly, their monthly, their quarterly numbers. This is very important to pay attention to. So we believe that the markets and interest rates will be set by the 10-year Treasury. That's what we're focusing on. But at some point, Operation Printed to Win It will begin. And when that begins, ladies and gentlemen, the entire cycles that we just went through will tell a story. None of this is financial advice. This is just my own opinion in any capacity. Don't get caught up like sushi here. Again, with the tweets coming in, the death by 1,000 headlines coming nonstop, it's very hard to pay attention to what's happening. Don't get caught up like sushi. Keep your Gucci conviction, your Gucci clarity. Remember why you started this long, frosty march up this frosty mountain with your frosty beverage. I'll see you on the front lines. I love you all. None of this is financial advice. This content is for educational and informational and entertainment purposes only. This is not financial advice. Always consult the licensed financial advisor. Never invest based solely on a YouTube video. I love you all. Pay attention to what's quiet. I'll see you on the front lines.